She was still holding the envelope when I walked in. She did not see me. Inside that envelope was the key to a pattern in the stock market that humans had missed for 20 years. But AI found it. And today, we're going to uncover it together. Why does this matter? Because understanding this pattern could give you an edge in your investment strategy. Imagine knowing something that most traders overlook. It's like having a secret map in a treasure hunt. And the best part, you don't need a PhD in finance to understand. Just stay tuned. Before we dive in, let's quickly go over what you'll need. All you require is access to a basic stock trading platform and an open mind. If you've been following our channel, you might remember our episode on why move from Robinhood to Fidelity. Well, any platform will work for this tutorial. So let's get started. First, we need to set up our analysis environment. Open your trading platform and navigate to the historical data section. Here, we'll pull down 20 years of daily closing prices for a major index like the S&P 500. Why 20 years? Because that's the time frame AI analyzed to find this pattern. Now, let's talk about the pattern itself. AI algorithms, specifically machine learning models, were trained on this extensive data set. They looked for correlations, trends, and anomalies that human analysts might miss. And they found something intriguing, a recurring cycle that appears every 730 days or roughly every 2 years. This cycle isn't immediately obvious when you look at standard chart. That's why it went unnoticed for so long. But once you know it's there, you can start to see it. The pattern shows a consistent dip followed by a sharp recovery. It's like the market is taking a deep breath and then exhaling with renewed strength. Here's where it gets interesting. Most traders focus on short-term fluctuations, missing the bigger picture. But this long-term cycle offers valuable insights. For example, if you can predict the timing of the dip, you can position yourself to buy low and sell high. It's a classic buy low, sell high strategy, but with a powerful twist. Let's walk through a practical example. Suppose it's January 2024 and the AI predicts a dip in June. You could start accumulating shares gradually, increasing your position as the price falls. Then, as the recovery begins, you sell off your holdings for a profit. Of course, this requires discipline and patience, but the potential rewards make it worth the effort. Now, let's talk about some pro tips. First, always validate the pattern with multiple indicators. Don't rely solely on this cycle. Combine it with other technical analysis tools for a more robust strategy. Second, consider using options to enhance your returns. Options can provide leverage and downside protection, making your trades more efficient. And here's an insider take. Most people think the stock market is purely random, but actually, patterns like this prove there's more to it. The market has rhythms and cycles that, when understood, can be harnessed for profit. But the real surprise is coming. As we near the end of this video, you'll see how this pattern ties into broader economic trends. Understanding these connections can give you an even deeper insight into market movements. So what's next? Now that you know about this hidden pattern, it's time to put it into practice. Start by reviewing your current portfolio and identifying opportunities to apply this strategy. And if you're enjoying this, hit subscribe. We post stories like this every day, and you don't want to miss the next one. Tomorrow, the sister's revenge 3 months later. Do not miss it. Rate this pattern's usefulness on a scale of 1 to 10. Was it enough, or should it have gone further? Remember, this information is not financial advice. Always do your own research and consult with a professional before making any investment decisions. Stay tuned for more insightful content from Finance AI Pro.